I'm Simon Edelsten from Goshawk Asset Management. We're a global equity manager which came together about a year and a half ago now, including the team, Alex Edingworth, myself, who used to be at Artemis Fund Managers running global equity funds, and Tim Gregory, Charlie Fricker and James Rousell, who worked at Vermeer Asset Management, also running global equity funds for the last 10 years. All of us started in the city, most of us started in the city many years ago, Tim, James and I, in the 1980s. And I think from the 1980s, the whole idea of quality growth emerged, inspired in part by Warren Buffett, who's been the most successful and certainly the most famous global equity investor over my lifetime and beyond. So Warren Buffett has been a great influence on many investors. And one of the finest things that he pointed out is that a good company can last a very long time and you get compound returns if you buy shares in it and leave them alone for decades, as he has, and just watch the share price go up as the management of that company keeps reinvesting and keeps growing its business globally. Now, this theory hasn't worked particularly well the last few years, and I'd like to try to explain why it's had challenges and what the future may be. Now, there are a couple of things that I'd like to point out. The first thing, I think, is the Warren Buffett's view that companies which have higher margins than you would expect, higher profitability than you would expect, will tend to attract competitors unless they have a barrier to entry. One of the most famous barriers to entry that he pointed out was branded goods companies. Coca-Cola, for instance, will tend to be able to sell its fizzy drinks more expensively than own label because it's Coca-Cola. So people will look at the Coca-Cola can and they'll say, I don't mind that it's a bit more expensive because I know what that's going to taste like. And I suspect that the other Cokes won't taste quite as good. And so you'll pay a bit more for it. That's your barriers to entry, their secret recipe for how they make it, locked away in a safe, I'm told, in Atlanta, Georgia, as it has been for generations. So that's a classic example of a company that Warren Buffett bought back in the 1950s, which has done him very well, which he's managed to buy and hold for decades, and which has grown itself through its higher level of profitability, reinvesting and being well run. Now, there's one very important, there are two aspects to this. Firstly, are the barriers to entry as good as they used to be? And secondly, what are the valuation points? So the first thing I should say about Warren Buffett's success here is that all equities in the 1950s and 1960s are considerably cheaper than equities have been for the last 30, 40 years. So even right up to the late 80s, because of the high levels of inflation there were around, equities tended to trade on quite low multiples of earnings. When you bought a share on one day, you could buy it on the basis of the cash flows that it would bring in over the next 3, 4, 5, 6 years. More recently, you've had to believe that those cash flows are going to carry on coming in years 10, 11, 12, 20, in order to justify the current share price. So the main valuation tool that you tend to use to value a share when you think it is a quality company, which is going to have higher than average margins into the future, makes assumptions that those margins are going to carry on, that the growth rate's going to carry on, and that therefore the share price that you're paying today isn't more than the future value of future cash flows discounted back. So this is the so-called discounted cash flow version of how to value shares. Now, when Warren Buffett was buying Coca-Cola or similar in the 50s and 60s, shares tended to trade on a single-digit multiple of earnings, PEs below 10. As many of you will know, there are not many companies around, certainly not many quality companies around on PEs below 10, and there haven't been for 40 years now. There were still a few around in the early 1990s. I remember Distillers, which is now the bulk of Diageo. I remember that being on 7 times earnings with a 7% yield in 1992. A long way away from the valuations that company has been on recently, which are more like the high 20s times earnings. So valuations are very, very different. And I think we all know, however good quality we think a company is, I think any experienced investor knows your in price really matters in terms of your total return buying any share of any quality at any time. So it's very important that one bears attention to value for money, even if you have identified a company you think is very high quality. It doesn't mean it's necessarily worth buying if the share price is too high. Now, the second problem here has been that a lot of the branded goods companies have not proved to be as reliable as people expected, particularly not the drinks companies. So I'm sure that you will have all read in the papers that younger people, particularly young people in the wealthier countries, are drinking much, much less than we used to in my day. So alcohol consumption, both beer and spirits, is well down, and that trend doesn't seem to be going away, and it's quite easily understood. I think as a percentage of the money that students have, the cost of going to the pub is much, much higher than it was 30 or 40 years ago. The cost of spirits has gone up, the cost of beer has gone up a lot compared with other things. And so it's not just a fashion thing that young people are drinking less. It's not just because they're working harder when they go to college. It's also because it's just terribly expensive. And so, everyone's on a budget. Students are always people who are looking for good value for money and trying to make sure that the money that they have goes as far as they can get it to go. And I'm afraid going to the pub has been one of the victims of that, not just in the UK, but globally. So when you invest in these companies which trade on high multiples because investors think that future earnings are reliable and can be easily predicted to come in years 7, 8, 9, 10 and 20, you've got to keep a very close eye on these trends, because if the trend for underlying demand isn't as good as you thought it was, it'll have a very dramatic impact on the share price. And this actually has also been compounded in a lot of branded goods companies because they've made a lot of acquisitions over the last 10 and 20 years. And so a number of them also are carrying rather more debt than they used to, tempted by the very low interest rates we've seen for the last 10 years. So quite small changes in sales and quite small changes in margins are then multiplied through to quite big changes in earnings because of the debt load. And that, of course, means that the share prices fall rather faster and further than you might expect, despite the fact the company from the outside is the same company as it was a few years ago. It's just not worth as much as people thought it was worth a few years ago. Lastly, I'd say, by the way, that a lot of these companies reached their all-time peak valuations during the pandemic, where their reliability as quality companies was seen as a safe haven when all other expectations of economic activity were up in the air because we're all locked up. So I'm afraid a lot of those companies, a lot of those quality growth companies, to us at Goshawk, just looked much too expensive to hold on to at the end of the pandemic. We thought that the share prices more than discounted. They were above the future value of their cash flows. So this is one area where I think at Goshawk we do disagree with the Warren Buffett approach. We don't buy and hold forever. Even if we think a company is a really good company, if we think the share price is too expensive, we sell the shares. And normally we can find something cheap around the world of a similar quality, which we can go off and invest in. Anyhow, that was the background which caused some problems for quality growth managers over the last 3 years, but I'm afraid it's been compounded by another problem more recently, which is a challenge by AI to software type models, which are quite different from branded goods type models. And software businesses, by and large, are not an area where Warren Buffett has particularly got involved. He has a very large holding in Apple. But the rest of the software sector is not particularly an area that he's famous for investing in. However, it does have some of the same characteristics. It has very high margins. It has very high return on capital invested, rather. Now, the trouble here is that those barriers to entry of writing software have never been particularly high. Anyone can write software. Famously, a lot of software businesses have started with people operating out of their garages without very much capital. The barrier to entry is often, once you're successful, if you manage to get everyone to use your software, you get a so-called network effect. So people who use Adobe Acrobat to PDF their files, send them to other people who hopefully have Adobe on their computers so that they can open and read those files. The same with Microsoft Word, the same with Microsoft Excel. We're not very pleased when somebody sends us a Word document or a text document anyway, formatted in a different format from Word. If we mainly are Word users on a computer, it's easier for us if everyone uses the same software. And so Microsoft and Adobe have benefited from that network effect, that if everyone uses it, then it's easier for everyone else to use it. And that creates a barrier to entry. However, these are some of the world's most valuable companies, so they're also targets for any new software writers. And the one thing that we know about AI, we don't know where AI is going to be successful, where it's going to make the most impact, the least impact. And many software companies no doubt will embrace AI to enhance the value of their own software products and to improve their relationship with their clients by giving them a new generation of more functional software without them having to change from one platform to another platform. However, the one thing we do know is that AI is speeding up its release of different applications at the moment. The products that we've seen over the last few years have not been particularly impressive, but some of the products coming out recently, particularly the Claude product from Anthropic, have made investors very, very nervous that a number of companies whose businesses rely on software in some form or data processing in some form, that they're going to face more competitors in future. And I think that fear is certainly correct, even if the market's taken a very general view of marking down everything, and no doubt not everything will be affected equally. But the fear will be around for a while, and the basic fundamental fact is the barriers to entry of competing with these businesses has gone down. And that should always affect share prices. It should always affect valuations. And it's because of that. Now at Goshawk, we have had some companies. We've got about 3 companies which have been hit by this. And each of those share prices has gone down a lot. And we sit there saying, I'm sure that's unfair. We don't know that these companies are going to be that badly affected by AI. In fact, we bought them because we thought they might benefit from AI. But the one thing we do at the moment is we say we're living in very uncertain times. We know that AI will get better. We know that the releases are speeding up. We know that there are trillions of dollars invested in making it a success. And so some of the revenue, some of the target markets for the AI software writers will be the big companies, big incumbent blue chip software type businesses out there quoted on the market. So let's not take anything for granted here. We know that competition has gone up, and we know that times are going to get tough. We know that the barriers to entry have gone down, and that should lead to a reduction in the share prices and the ratings. And that's what's happened. So our view here is we're going to keep with the small positions that we've got in the companies affected. Fortunately, our portfolios, we've never wanted to run very highly concentrated portfolios. We just don't think the world is a easy place to say, here are 25, 35 stocks. These are all the good stocks that we can find in the world. We just don't believe that. We also think that if you only are running a 25 or 35 stock portfolio, any one of those stocks, if it gets hit by an unexpected technology development or challenge, and one share or 2 or 3 shares, all of which are correlated, they all get affected at the same time, you're going to have a terrible period of performance because they're all big holdings. Instead of that, we run a much broader portfolio, 65 stocks. We have a much broader definition of what's quality. Our definition of what's quality includes Japanese companies which do not have very high margins, but which have massive global market shares. And in their own ways, because they have very strong businesses and often are technology leaders in what they do, it doesn't mean that they're not quality just because they don't have the sort of margins that an American company would charge for the same product. So because we have a broader definition of what we regard as quality, we then have a more diversified portfolio with more stocks, and more stocks which have less correlation. So we have eggs in many more baskets, I think, than a number of our peers. And that helps us through times like this, times of uncertainty. And I'm afraid we think that the uncertain times are going to carry on. So the messages that we bring out of the issues that we've faced over the last few months may not be surprising ones. Be diversified. Make sure that you don't have too many stocks which are surprisingly correlated with any one threat, particularly not the AI threat. And we're trying to make sure our portfolios get over that acid test at the moment. And as ever, valuation is key. Don't hold on to stocks if they look expensive. There's always stocks out there which look cheap. And fortunately, we're still finding plenty of stocks in the world which look good value for money, which allow us to make sure that we've got a decent quality growth portfolio, but without excess valuation and with really broad diversification. And that seems to be helping us through these tricky times. I hope that you found that interesting, and I hope that adds something to the issues in the market at the moment. If you've got any questions, there is an email address on our website. Our website is www.goshawkam.com. And I'll be very willing to answer any questions that anyone sends in. Thank you very much for listening. Goodbye.
The content of this video is provided for information purposes only and is not intended to be an offer or solicitation, nor is it intended to be investment advice. The funds run by Goshawk Asset Management may have positions in any of the stocks discussed, but their inclusion in this video should not be taken as a recommendation. Historical performance information is presented by way of example only, and this video may contain forward-looking information that is not purely historical in nature, with no representation made that the performance presented will be achieved and no guarantee that any forecast will come to pass. Reliance upon information in this video is at the sole discretion of the viewer. It is not intended to be relied on in making or refraining from making any specific investments or other decisions. Opinions expressed, whether specifically, in general, or both, on the performance of individual securities and in a wider economic context, represent our view at the time of preparation and are subject to change. We hope that's helpful.